Hello everyone, welcome back to the channel. Today we are talking about empires, big, powerful, global empires. But we are not talking about ancient Rome. We are talking about corporate giants, tech stars, energy titans. Why do they fall? You might think it is bad luck. You might think it is a changing market. You are often wrong. These giants fall because of lies. Pure, calculated, billion-dollar lies. Today, I want to take you on a journey. We will analyze 4 massive corporate scandals. We will look at Ferranti, Enron, Parmalat, and Wirecard. We will look at the brilliant but twisted minds behind them. We will see the massive failures of auditors. We will see the protection of villains by state regulators. The architecture of a corporate collapse is rarely an accident. It is a highly designed system of hidden accounting. Sit back, hit that like button, and let us dive into the dark world of corporate fraud. Let us start in the United Kingdom. Have you ever heard of Ferranti? They were a massive giant. They were a strong pillar of British electrical and defense engineering. They built radars. They built early computers. They survived for over a century. But in 1987, they made a fatal mistake. They bought an American company called International Signal and Control, or ISC. ISC looked like a highly profitable high-tech supplier. The founder was a man named James Garron. He was considered a true patriot. But Garron was actually running a massive scam. His business was largely based on unauthorized defense contracts. He shipped prohibited defense technology to countries like South Africa and Iraq. He used a system of circular cash transfers. He created totally fake international contracts. Ferranti wanted to expand into the U.S. market. They ignored the obvious red flags. ISC registered in the UK to avoid strict U.S. regulations. Ferranti thought this was just a simple technical detail. It was not. Garron also used a proxy board to hide details from Ferranti. He claimed the details were U.S. national security secrets. This trick successfully blocked any real audit. The merger happened. The illegal arms sales suddenly stopped. The hidden cash flow dried up immediately. Ferranti was left with massive debts and fake assets. By 1989, internal audits proved the contracts were pure fiction. A century-old legacy was destroyed by one bad merger. Ferranti went bankrupt in 1993. It is a very tragic story. It shows the danger of blind ambition. It shows the death of common sense. Now, let us cross the ocean to the United States. Welcome to the incredible story of Enron. Enron remains the ultimate symbol of corporate fraud. In the year 2001, Enron was the 7th largest company in the U.S. They were an absolute energy giant. Everyone loved them. Wall Street analysts pushed their stock aggressively. But the company was a complete illusion. Enron used very complex accounting loopholes. They used a method called mark-to-market accounting. This method allowed them to project future profits from a long-term contract. They then recorded those future profits as current income. Imagine predicting you will make $10 million over 20 years. Now imagine putting all $10 million on today's balance sheet immediately. It is pure financial fiction. But the situation gets worse. Enron had very greedy executives. Let us talk about Jeff Skilling, the CEO, and Andrew Fastow, the CFO. They created special purpose entities, or SPEs. They gave them cool names like Chuco, LJM, and Raptor. These SPEs were used to hide Enron's massive debts. Enron transferred bad assets to these hidden structures. There was a special accounting rule back then. It was called the 3% rule, and SPE did not have to be reported on Enron's balance sheet. The requirement was simple. An independent party needed to own just 3% of it. But these parties were not independent at all. Fastow himself controlled some of them directly. He made millions in secret bonuses. They even used Enron's own stock to guarantee the SPEs. The dot-com bubble eventually burst. Enron's stock price fell drastically. The whole structure collapsed quickly. The SPEs could not cover the massive losses. Enron went bankrupt. Shareholders lost $74 billion. The famous auditing firm Arthur Andersen was destroyed. They helped hide the truth. They even destroyed important documents. Enron proves a vital point. Complexity is often just a mask for theft. Let us move to Italy. You might think European regulations are stricter. Think again. Enter Parmalat. This was a global dairy and food giant. It was Italy's seventh largest company. Callisto Tonzi founded it. He built a huge empire. Parmalat had over 30,000 employees. They sponsored Formula One teams. They owned a football club. But behind the milk and yogurt, there was a massive financial black hole. In 2003, Parmalat collapsed. They had a €14 billion hole in their accounts. People often call this Europe's Enron. How did they hide it? The method was shockingly simple. Enron used complex financial engineering. Parmalat used a scanner and a printer. I am not joking. Parmalat claimed they had nearly €4 billion in a Bank of America account. This account supposedly belonged to a subsidiary called Bonlat. Bonlat was based in the Cayman Islands. It was completely fake. Employees literally forged Bank of America documents. They scanned real letterheads and typed in fake numbers. They also intercepted mail from auditors. They did this to confirm these fake balances. Parmalat also had something called Account 999. This was literally a digital trash bin. Managers dumped billions in fake revenues and assets into this account. They transformed fake numbers into fake intercompany loans. Just before the collapse, executives panicked. They tried to destroy the computer holding Account 999 with a physical hammer, but a printout survived. Auditors from Grant Thornton and Deloitte failed completely. They missed a decade of crude, basic fraud. They trusted forged papers. Tonzi later claimed ignorance. He said he did not know what his own executives were doing. The lesson here is terrifying. You do not always need brilliant financial minds to fool the world. Sometimes you just need a lot of arrogance and a decent office scanner. Finally, we arrive in the modern digital age. Let us talk about Germany and Wirecard. This was a massive fintech darling. It processed digital payments globally. It was worth $30 billion. It replaced Commerzbank in the prestigious DAX 30 index. Everyone in Germany was so proud, but it was a fragile house of cards. The main characters here are CEO Markus Braun and COO Jan Marsalek. Marsalek is currently a fugitive on the run. They used a system called third-party acquirers, or TPAs. Wirecard claimed they used these partners in Asia. They supposedly lacked local licenses. They claimed massive profits were sitting in trust accounts in the Philippines. But a journalist named Dan McCrum from the Financial Times smelled a rat. He started investigating in 2014. His story is exactly like a spy thriller. McCrum faced severe harassment. Private detectives followed him everywhere. Wirecard executives were linked to foreign intelligence operatives. McCrum had to work in a windowless bunker on a disconnected laptop. He used untraceable burner phones. His colleague visited a major Wirecard partner in Manila. She found a tiny office. It was shared with a tour bus company. There was no massive payments operation. It was entirely fake. The revenues were created by moving money in circles. This simulated organic growth. How did regulators react? The German regulator, BaFin, defended Wirecard. BaFin filed criminal complaints against the journalists. They banned short selling of Wirecard stock. They attacked the messengers relentlessly. In 2020, the truth came out. KPMG and EY finally admitted the reality. Exactly 1.9 billion euros were missing. The Philippine banks said Wirecard was never even a client. The money never existed. The company crashed. Marsalek vanished into thin air. Wirecard proved a sad fact. Even today, massive fraud can happen in plain sight. So, what do these four disasters teach us? Let us analyze the common threads. First, the auditors constantly fail. Arthur Andersen, Deloitte, Grant Thornton, and EY all failed miserably. They are supposed gatekeepers, but they get paid by the very companies they audit. This creates a massive conflict of interest. They prioritize client relationships over the hard truth. Second, complexity is a dangerous weapon. Enron used SPEs, Wirecard used Asian TPAs, ISC used proxy boards. A business model should be easy to explain. When it is too complex, it is often a mask for deceit. Real businesses make real products. Real businesses generate real cash. Third, corporate culture matters greatly. In all these companies, management fostered a toxic culture. They valued rapid growth above ethics. They punished honest whistleblowers. They bullied external critics. Finally, regulators often fall asleep at the wheel. BaFin protected Wirecard. They wanted to protect the national championship. The SEC was too slow with Enron. We cannot blindly trust the system. We need independent journalists like Dan McCrum. We need brave whistleblowers. Always question the numbers. Do not fall for the hype. Look past the shiny corporate headquarters. Thank you for watching today. If you find this analysis interesting, please hit the like button. Subscribe to the channel for more deep dives into the world of finance and crime. Share your thoughts in the comments below. Which of these scandals shock you the most? I will see you in the next video.